Hello everyone, welcome to the channel of Qianmo. In this video, we will introduce CGT, which is capital gain tax. You must have heard about capital gain tax very often. Capital gain is disclosed as assessable income, and the CGT provisions are found in the Income Tax Assessment Act. For example, when reporting an individual income tax, net capital gain or capital loss is declared as assessable income under the item 18 on the income tax return. Well, how should we understand capital gain? One of the very common examples is like when you sell a house. Your selling price is greater than the price when you purchased it many years ago. That gain is obviously capital gain. But how about selling your financial assets like your shares, your car, your jewelries, your boat, for example, or how about you received compensation from the loss of an object? Are those gains capital gain as well? And should people be paying tax on them? Now you see, capital gain can pose questions in a lot of circumstances. So how should we look at capital gain tax from a professional point of view when we are working as a professional accountant? Capital gain tax regime generally applies to CGT event that happen to a CGT assets acquired by a taxpayer after 19th September 1985. Okay, this demonstrates a few important concepts. First, CGT event. A taxpayer can only make a capital gain or loss if a CGT event happens. So what is CGT event? For example, when you sell an asset that is subject to capital gain tax, it is called a CGT event. Why? Because it is according to the law. We can find a comprehensive list on the ATO's website. This list is coming from the Income Tax Assessment Act 1997. As we can see, there are many other CGT events as well, such as the loss or destruction of an asset or creating contractual or other rights. Second, timing. The specific time when a CGT event happens is very important. In particular, the timing is relevant for working out whether a capital gain or loss from the event affects the taxpayer's income for the current income year, as well as whether that gain is entitled to CGT discount. For example, if a CGT event involves a contract, the time of the event is usually when the contract is executed. Also, we need to remember the date of 20th September 1985, as this date was when the capital gain tax was introduced. Therefore, any assets purchased prior to that date do not attract CGT. Third, CGT asset. Many CGT assets are easily recognizable. For example, land and buildings, shares, units in a unit trust, collectibles, and personal use assets, etc. Some others are not as widely recognized. For example, contractual rights and goodwill. Now let's think about a question. Surely you would agree that an apartment owned by an individual resident is a CGT asset. How about a few hundred apartments that are about to be sold by a real estate developer? Are they capital assets as well? Okay, they are actually not. As to the real estate developing business, selling apartments are their main business activity and happens regularly and repetitively. So those sales are recorded in the company's revenue account, not capital account, and they are the company's ordinary income rather than capital gain. It is also worth noting that even though most CGT events involve a CGT asset, there are still some CGT events are concerned directly with capital receipts and do not involve a CGT asset. For most CGT events, a capital gain arises if a taxpayer receives amounts from the CGT event which exceed the taxpayer's cost associated with that event. Conversely, a tax loss arises. Once we've identified the capital event and have come up with a capital gain or loss, it doesn't mean that we absolutely are liable for tax on the capital gains, as we may be able to apply exemptions on the capital gain to reduce or eliminate that gain or loss. For example, one of the exemptions that makes a lot of difference is the main residence exemption. In other words, if the house you have sold is your own home that you live or lived in, you may be able to apply this exemption and do not pay tax on the capital gain at all. Other than above, 50% discount can also be applied if certain conditions are met. Now, let's take an example of how the tax on capital gains are calculated. Let's say that Tom bought a house under his own name in 2001 for $300,000 and sold it in 2015 for $700,000. What would be the tax implications? Okay, firstly, we will examine if there is a CGT event happened in 2015 at the time it was sold. The answer is yes, because it is CGT event A1, disposal of a CGT asset. Second step, let's look at if there is any gains or loss from this capital event. The capital proceed is obviously $700K, not considering any other incidental or associated costs. And the cost base is $300K. So there is a capital gain of $400K. Now it's time to consider whether there are any exemptions or rollovers to apply to this capital gain. For example, if this house is Tom's main residence, in other words, his home that he lives in, great news then. He can apply the main residence exemption and all that capital gain is exempt. And he doesn't have to pay any tax on that capital gain. Let's think about another scenario and say if Tom is a rich guy and has a few investment properties and that is only one of his properties, then he can't apply for this main residence exemption. However, assume he had capital losses from selling his other investment properties in previous years. Then the good news is those capital losses are carried forward to the current year, and now he can use those capital losses to reduce the capital gain. Say he has carried forward capital losses of $200K, then $400K minus the $200K loss, he is left with $200K of net capital gain. Is that it? No, not over yet. Now, since he is an individual, which is an entity that 50% discount is allowed when the asset is held for more than 12 months, he can also apply discount on this net capital gain. Lucky guy. So in the end, the capital gain to be declared on the income tax return as assessable income is only $100K. Let's say that his marginal income tax rate is 39% for this current financial year, which is 37% plus 2% Medicare levy. Then he ended up paying $39K tax on the capital gain he had made. Okay, this is only a simplified example to show the basic logic of how tax on capital gain works. Normally, we would perform quite often this kind of capital gain tax calculations at the early stage of our career in accounting firms. However, as time goes on, we are more likely to be exposed to much more complicated tax matters in terms of capital gain. The analysis of various capital events via both the legislation and the previous legal cases, and eventually identifying the logic behind solving the tax matter is a real logical exercise. And I find that actually a very interesting brain exercise. I have to say that after many years working on various tax matters as an accountant, I wouldn't say I've become an expert, but my logical and analytical skills have improved for sure. Okay, so much for today's topic. See you in the next video.